Hello and welcome. There's a lot of interesting information that Sarah and Jan will present to you in this lesson that should help you understand just how important corporate credit can be to your success as a real estate investor. But before turning the time over to Sarah and Jan, let me mention that most people realize that the majority of businesses handle their day-to-day operations by using credit. In fact, credit is becoming increasingly important for companies so they can buy supplies, pay bills, and of course, invest. However, establishing credit for a business doesn't happen overnight. Like anything valuable, it takes time to grow and establish. One of the main goals of this lesson is to teach you how to take advantage of and generate corporate credit. Now, generally speaking, the older a business is, the more options it will have to build credit, obtain loans, and secure other lines of credit without having to rely on personal guarantees. But regardless of the age of a company or its financial history, in order to obtain or gain more corporate credit, one has to convince those who control the money to give it to the business. Of course, it's understood that when those who have the money divvy it out, those who accept it do so under the lender's conditions. That is to say, if your business receives a loan from Company J, then your business accepts the interest rate, payment schedule, and default terms. That's why shopping around to get the best deal on the money is so important. But however you decide to get the money and however big or small your business is, you should use corporate credit to provide your business more financial options to buy, rehab, and sell property, or maybe even buy and rent it out without risking your own credit. You should know by now that realistically the sky's the limit when it comes to growing your real estate business. However, invariably you'll run into barriers on the way. One of those barriers might be the amount of money your personal credit will allow you to acquire, or the number of private funding sources you can retain. Well, by using corporate credit, not only do you overcome that financial barrier, but you distance your personal financial situation from your businesses. So with that, let's get started. Sarah, Jan, are you ready?
Absolutely. Please allow me to welcome you to this lesson as well. It should be an enlightening one for you, and our hope is that by the end of it, you'll have a great understanding of how corporate credit works and how you and your business can benefit from it. But before Jan and I get into the lesson material, I would like to review some of the things you should know that'll help ensure you understand the information we'll present. So before going too far into this lesson, you should have a functional understanding of the basic principles and terminology used in real estate investing. You should also have determined what kinds of property you are interested in and what you plan on doing with them. As part of that, you should have a solid understanding of how to find motivated sellers, how to perform an income property analysis, as well as how to calculate a solid offer. And finally, you should be comfortable discussing the basic investing strategies that have been previously discussed. Now, let me turn the time over to Jan, and she will explain what we'll cover in this lesson.
Thanks, Sarah. I sure will. However, before I explain what you'll learn in this lesson, I too would like to welcome you and say that this is a very intriguing lesson, whose benefits are really beyond measure. Also, because we'll be covering so much information, I hope you have a pen and paper available to take some notes and have printed out the lesson guide and workbook. So with that said, here's what you'll learn today. You'll learn what corporate credit is and the various types of lenders who give it. You'll come away with an understanding of how corporate lenders determine creditworthiness for business credit, as well as the different kinds of credit your business can get. Finally, and possibly most importantly, you'll learn how to effectively build and maintain corporate credit. Having all this information at your disposal will allow your business to reach new heights that you may have not expected before. So, with nothing further, Sarah, will you start us off with our tips for success?
I'd be happy to. As you look into corporate credit, there are a few facts you should evaluate and keep in mind. Fact 1. Small business credit reports aren't always completely separate from personal credit reports. You may have heard that small business credit and personal credit are completely separate. Well, they can be, but it's not a given that they will be. Some of the business credit bureaus, such as Dun & Bradstreet and Credit.net, don't collect information on individuals' personal credit histories, so that personal information won't become part of the business's credit score. But agencies such as Experian and Equifax collect and maintain consumers' personal credit ratings, and they may blend that information with the business credit score to produce a combined score for a small business. So if you have bad credit, you might consider establishing a partnership and writing up a corporate resolution stating that the partner with the best credit is the one whose score should be evaluated for the purpose of obtaining corporate credit. For example, Harry and David created an LLC named Paradise Properties. Harry had recently gone through a bankruptcy, making it so he didn't have very good credit. David, on the other hand, had great credit, so the two of them created a corporate resolution stating that David's credit report should be the one used for credit evaluation purposes. They both signed the resolution and took it to their local bank and presented it when they opened a business checking account and applied for a corporate credit card. The bank accepted the resolution and only looked at David's credit to determine if they would be approved and the amount of credit the business would be issued. Fact 2. The Paydex is not the only business credit report. If you've ever researched business credit programs, you've probably seen them refer almost exclusively to the Paydex score offered by Dun & Bradstreet. Well, while it's true that this is one important credit score, it's not by any means the only game in town. In fact, there are lenders that'll never use a Paydex score to evaluate your loan. Instead, they'll rely on other credit reports and scores offered through Experian, Equifax, and the Small Business Exchange, and other business credit bureaus. One reason that lenders should look at multiple agencies is that some lenders report to one bureau but not to others. So, as a small business owner, knowing where your business stands in relation to each business credit agency is helpful if you're trying to borrow from traditional lenders. If you'd like to avoid the whole mess, you can focus on only those lenders who report exclusively to Dun & Bradstreet. Fact 3. Paying your bills on time isn't enough to guarantee strong business credit. To build business credit, you must borrow money or buy products and services from companies that will report your payments to the major business credit reporting agencies. Because if your payment history isn't reported, it isn't helping to build your business credit profile. Fact 4. When it comes to building corporate credit, you'll want to get it right the first time. See, business credit reports aren't covered by federal laws that govern personal credit reports. You don't have the same rights when it comes to disputing the accuracy of information in your business credit file. Therefore, you want to make sure you start out on the right foot, or it can be difficult to get corrections or updates made to improve your rating. That's not to say that corrections can't be made to your business credit report, but it is more time-consuming and a bit more difficult. So avoid that problem altogether as much as possible by starting out right. Now, take some time to review these facts, get yourself comfortable and organized, and get ready to learn some great stuff about corporate credit.
If you've never had any experience with corporate credit, it can be a little confusing. But even with the potential confusion, the benefits are numerous. So much so that it's certainly worth getting to know exactly what corporate credit means and how it can help your business. Corporate credit, or business credit, is a revolution in the lending world. Essentially, it's an unsecured loan issued to a business entity that, when done correctly, doesn't tie the business owner's personal assets or credit ratings to the debt. However, most financiers do still verify the business owner's personal credit record, but only as a means of establishing their credibility as a borrower. So the bottom line is, as a small business owner, you no longer need to try and finance your business by pledging your home or other major assets as collateral anymore. In a way, your business becomes an extension of your credit options, because with it, and with each new entity you create, you can open new lines of credit and loan options as a means of growing that particular business. You can gain access to a lot more money by having multiple businesses than you ever could by using just one or just your personal credit. For example, if you recall, when you first started as a credit consumer, you probably got a credit card with a credit limit of a few hundred, maybe a couple $1,000s. But after just a couple of years of using that credit and paying it off, you were probably able to borrow several thousands. maybe even enough to finance a new car or buy a house. Your corporate credit works the same way. You qualify for a little at the beginning, but more and more as you use it well. And just like you can use consumer credit for a variety of things, you can use corporate credit for all sorts of things related to your business, including getting credit cards from retail businesses, establishing lines of credit with companies or banks that you deal with, leasing equipment or cars for the business, and of course, buying real estate. With some time, patience, and good spending, and paying habits, you'll earn a great business credit score and be able to get the funding you need to take your real estate investing to the next level.
Just as our life has different monetary requirements at different junctures, businesses too have their financial twists and turns when they need additional funds. Obtaining personal loans for corporate use, while a very popular strategy, can have potentially serious negative repercussions later on. As has been mentioned, personal loans are given against your personal assets or credit, so defaults may result in a bad credit score, low credit rating, blacklisting your personal name for any future loans or credit, or may even result in your personal property being lost in the event of legal proceedings. This potential risk creates the needs for business loans, which are independent of your personal credit and property. Similarly, each time a bank or credit organization makes an inquiry into your personal credit score, it actually drops your score by about 2 points. With corporate credit, lenders can make several inquiries and it never affects your personal score. Another drawback to using personal credit for the business is that doing so increases your debt-to-income ratio and makes you less likely to qualify for another personal loan in the event you needed one. Also, keep in mind that personal credit and loans are attached to your Social Security number, and any debts you accrue, even if used for the business, follow you until they are paid, regardless if the business is still operating or not. It's vital, therefore, to establish a line of credit under the business tax ID number as opposed to your Social Security number. To help illustrate why using personal credit for the business is bad, let's look at an investor named Debbie. Debbie started an LLC that she planned on using to buy improved lots in Arizona. She registered the business, opened a business checking account, and secured a business credit card from her bank with a limit of $5,500. Unfortunately, Debbie was impatient and didn't want to wait and establish a larger line of credit. So, she used her personal lines of credit to supplement the money she needed to start buying properties. But not only did she mix funds, she also maxed out her personal credit. The result was a credit stalemate. See, she couldn't obtain any more credit for the LLC because her current credit situation wasn't very appealing, which in turn made it so she couldn't build her corporate credit any faster, and she couldn't get any more personal credit since her debt-to-income ratio was too high. Debbie had to wait 6 months to get the money from the 3 lots she sold so she could pay down her debt and lower her personal debt-to-income. Only then could she continue building her corporate credit and accessing more funds in the long run than she could using her personal credit.
Now, in spite of its many benefits, some business owners still don't make an effort to obtain corporate credit. The most probable reasons for such a lack of effort must be that either they're uneducated in the concept of corporate credit or they don't know how to build it. As a result, they deprive their businesses of the benefits corporate credit provides, such as low interest rates, no LTV, and huge loan amounts, which in turn ends up hurting their ability to make money. Even the government says it's in your best interest to establish and use corporate credit. That's because different business entities can write off more and more legitimate business expenses than are possible on personal tax returns. Are you starting to see that using corporate credit is a better idea than using your personal credit? Just a couple of other items associated with business credit. The first has to do with your business credit score. Did you know your business has its own credit score? It does. However, while personal scores range from 300 to 850, Most business credit scores are rated on a scale of 0 to 100. So if your company can get and maintain a score of 75 or higher, you are considered an excellent credit risk. Such a good score can be achieved by having multiple accounts that are in good standing, up to date, and are using less than 30% of the available balance on them. Another thing to be aware of concerning your business credit score is that while there are several companies that collect information and determine business credit scores, it's voluntary to submit information to them. So there are actually relatively few businesses that know how to and take the time to report this information. Finding the companies that collect the information and submitting information to them is key to establishing your business credit. We will discuss this in more detail later in the lesson.
We have mentioned several reasons why using corporate credit is beneficial for you and your business. But let me just take a minute to list all the reasons at once here. The first and most obvious benefit is that corporate credit can get you the money you need to maintain your investing business. Without proper financing, you'll never be able to launch or expand your business. Second, corporate credit gives you access to more money and allows you to turn a profit faster than if you didn't have it. Since you have access to larger amounts, you can move on deals a lot faster, turn properties around a lot faster, and thus make a profit that much faster. The faster you can turn money, the more money you can make in a given time frame. Third, you can sustain your business through tough times by having other sources of capital. You won't always be able to foresee how the economy will change and either benefit your business or hurt it. Corporate credit can save your business during a slow period. Fourth, corporate credit can save you money. As a general rule, corporate credit interest rates are usually lower than personal credit rates, and even just shaving off a few percentage points of interest can add up to thousands of dollars in long-term savings. So essentially, corporate credit keeps you from spending money you don't have to. Fifth, corporate credit can protect you. If your business fails, any loans you secured personally will follow you. Corporate credit, if it's established correctly, typically does not. Similarly, by using corporate credit, you don't jeopardize your personal assets in the event something goes terribly wrong with your investing business. Sixth, it helps you and your business establish credibility. By having money to invest and to use for advertising, it makes the business look that much more legitimate in the public eye. And, believe it or not, if other lenders see your business can get credit, they are a bit more prone to extend credit as well. Number 7, it can be used to replace or in place of other financing options. For instance, maybe you have used your personal credit to obtain a mortgage on a property and now you want to get it out of your name. Well, if you've built up your corporate credit to the point where your business can qualify for a mortgage, then you could use the business credit to secure new financing and get the loan off your credit and protect you from personal liability. Eighth, corporate credit can be used to finance expansion projects that increase volume and enlarge potential revenue. And finally, you may have to pass up really good business deals if you don't have corporate credit. And passing on some of those deals could be detrimental to your overall business, especially in its early stages. So the point is, if you have any type of corporation, LLC, S Corp, or C Corp, then it's imperative to your success that you build corporate credit now. Too many people make the mistake of waiting until they absolutely need it before they go after it, and as a result, they end up stressed out and in a pinch. So, start applying now, especially since it can take a while to get those credit applications approved.
When it comes to obtaining corporate credit, there are a wide variety of lenders you can get it from. Here are some that you should consider looking into. First, there is, well, you. Surprised? Did you know that you can actually loan funds to your own company? It's true. The source for the cash could be equity from properties, cash in the bank, or retirement funds. If you do lend to your business, though, you'll want to make sure you create a promissory note that states the amount borrowed, who it's from, who's receiving it, the loan start date and end date, the interest rate, and terms of default. Essentially, just like you would create and document any other type of loan, this difference is that you originate it. This is a nice option for those who have available cash to lend their businesses. It helps establish some corporate credibility while keeping your personal assets separate from the business and therefore safe from litigation. A second option is to use family and friends. Now, you'll want to be a little sensitive with this one since money issues between family and friends can get rather bad rather quickly. But family and friends can be a great option to start building some credibility. If you choose to go this route, make sure you follow the same guidelines as were just listed to create and document that the loan took place and the terms for repayment. You can also check into commercial lenders. There are all kinds of lending institutions that'll look at your business's D&B rating and Paydex score and then determine if your business is a good credit risk. If it is, they will loan your business money based on what they deem is going to preserve the lowest risk for them. Even if you don't have an established Paydex score, there are some lenders who will still loan to you to help you out. These lenders will generally look at your personal credit to determine if they will lend to you or not. But the loan will still be tied to the business, not your personal credit. Another option is to check state and local government programs. There are generally several government agencies that have loan or grant programs you can apply for to secure funds for your new small business. After all, more successful businesses in the area mean more tax revenue for the district, and they always like that. Also, certainly take the time to check with the Small Business Administration, or SBA. The SBA will ensure loans made by commercial lenders for funding small business ventures. They'll look at your business credit risk and determine if your business is a good investment and for how much they feel comfortable lending. In many cases, you'll have a hard time securing SBA funds if you state you're going to invest with it. You'll want to make sure you show other financial needs that your business has in order to justify the funds requested. Also, in some cases, they might require you to have been in business for 2 years before they'll qualify you for a loan. And in terms of getting in contact with the SBA, generally, the bank with which you have your business checking account is the best place to request an SBA loan. Talk to the commercial loan manager, and they should be able to give you some assistance. You can also use so-called angel investors to get money. Angel investors are private individuals or a group of private individuals who have funds that they like to invest in small business ventures. While looking for a suitable investment, they are also looking for an opportunity to make a great return on their money and will typically be more flexible in what they will lend money on than most other lenders. They will require a good rate of return for the money they lend, but possibly not as high a rate as a venture capitalist would require. Also, they will normally require a business plan with proof of an established business entity and see a track history of experience, or at least a viable product or result. You can learn more about this kind of investor in the Working with Private Investors lesson. The last money source we'll discuss is venture capitalists. Venture capitalists are people who invest in business ventures by providing capital for new product startup or expansion. They are generally looking for a higher rate of return than would be given by more traditional investments, so they may be a bit more expensive than some of the other options. Typically, venture capitalists are looking for established businesses who are starting a new line or a new branch, as well as larger businesses to fund, so they may not be your best place to start looking for funds, but they are certainly a good option after you have been in business for a couple of years. Review these options for money, and when you're ready, click Next and listen as Sarah and I explain how some of these lenders determine business creditworthiness.
In the credit world, many lenders use what's known as the 5 C's to determine creditworthiness. These 5 C's apply to both individuals and businesses. Here's an explanation of what they are and how they are used for corporate credit. The first C is your business's character. When a lender judges your business's character, they're looking at your size, location, years in business, number of employees, stock performance when applicable, and several other defining characteristics. This is why it's very important that your business has a physical address, a business phone that gets answered professionally during business hours, and any necessary business licenses according to your state's requirements. The second C is your business's capacity. Capacity focuses on the business's ability to pay its current bills, but it also takes into account past credit histories, cash flows, and other past debt. Therefore, it's vital that as a business owner, you've paid all your credit bills on time and continue to do so. A late payment on a credit bill is a negative mark against your business's credit capacity that's not easily removed. Another important component of your business's capacity is to make sure you're building a credit history on your available credit lines. Don't let any available credit lie stagnant. Recall that doing so actually reflects poorly on your business credit rating. If you've yet to start using corporate credit, get some small lines such as gas cards, home improvement store cards, etc., and use them. If you've been using your corporate credit lines already, check to make sure the vendors you frequent have been reporting your good payment history. You'll need at least 5 business references to obtain a Paydex score, and better Paydex scores bring your business higher loan amounts and better loan rates, or, in other words, more capacity. The third of the 5 C's is capital. Your business capital assesses whether the business has the financial resources to repay creditors. This particular component of the 5 C's is usually the most closely inspected by lenders when considering a loan request. It's also a convincing argument against your personal credit to fund your business expenses because the basis of your business capital is reflected in the business's debt-to-income ratio, and if the majority of your business credit is personal, you're making it very difficult for your business to be judged on its own merits. The fourth C is conditions. Conditions are the external factors surrounding your business. When evaluating conditions, a bank may consider general market fluctuations, growth rate of the industry, and currency rates, and other market-related items. Because these factors are outside your control, it gives another good reason to start securing lines of credit now, because it may be even harder to get the money you need in the future. Furthermore, if times do get hard for your business due to market fluctuations, you'll be very glad you already have some reserves in place to get you through the tough times. The fifth C is collateral. Collateral is essentially the tangible assets, equipment, real estate, etc. a lender can sell if the business defaults on its loan. Most new business owners have a little trouble with this one because there's typically not much the business owns, at least in the beginning. In fact, sometimes new business owners will pledge personal assets for the company debt simply because the business doesn't have any collateral that can be offered to the lender. However, make sure you are very careful with this, since it's in your best interest to keep your personal assets separate from the business.
There are several different types of credit you'll develop over the life of your business. Some of the forms of corporate credit include secured credit lines with your bank, unsecured credit cards, vehicle leases or loans, supplier credit lines, real estate mortgages, and equipment leases. But, simply stated, corporate credit can be broken into 2 forms: vendor credit and line of cash credit. Because of its fluidity, line of cash credit should be your main goal, but it is not always easy to get. Therefore, vendor credit is a great stepping stone. Let's talk about both. Vendor credit is generally only good at one location. For example, an office supply store may extend your business a $2,000 line of credit to buy paper, pens, etc. Or you might get a credit line through a supply company, such as a home improvement or hardware store, that you can only use at that supply company. Now, these lines are good since they help build your credibility and business credit worthiness, but they're not the kind of credit that'll really allow your business to grow and flourish into the future. Your end goal is to obtain a line of cash credit, which is the true pot of gold. This kind of credit gives you access to money that you can spend when, where, and how you want. and the money you get comes from banks, not individual vendors. So when you begin building business credit, make sure you are focusing on building the right kind of credit the best way you can and at the right time. But keep in mind, you can't build lines of cash credit easily without having a business credit rating, so you must start with vendor lines of credit or credit cards.
Banks are generally quick to offer their credit cards to you for your small business or corporation when you open a business checking or savings account with them. But while they're easy to sign up for, don't assume they're the best deal or that they won't show up on your personal credit. Take the time to shop around for the business credit card that best matches what you're looking to do with your business. Consider following these tips to help you as you shop around. First, compare each card's features and benefits. You can even be a bit selfish when it comes to choosing what benefits you want attached to the card. But keep in mind that the point of the card is to build your business's credit and not affect your personal credit. Second, look for a card with low or no annual fees. Just by using the card, you're paying interest on your purchases. So why would you pay a company more just to own their card? So you can find a good business credit card deal with low or no annual fees if you check out various credit card offers available online. Our third tip is to sit down and think of how you'll use your business credit card. If you'll mostly charge travel or office supply expenses, then your main focus might be on getting a low annual percentage rate, APR. Whereas, if you're planning on charging higher ticket items, then certain rewards might be more desirable for you. Fourth, if your business consistently keeps monthly balances, then make sure you get the best interest rate possible. In fact, when credit card companies see you consistently carry a balance, they'll often offer you better rates or other bonuses as a way to get your business. Fifth, seek out credit card companies that provide detailed expense reporting. This service can be very valuable come tax time, as it can help you keep more of your profits in your pockets. One thing to watch out for as you look at the various companies is to see if they don't charge an added fee for this service. Some do, and some don't.
Having a business credit card is essential to building your corporate credit profile. Demonstrating reasonable usage and maintaining a good payment history not only allows you to gain more credit, but also helps you negotiate better interest rates on loans, lines of credit, and other revolving accounts. In fact, using a credit card properly is better than paying cash because lenders like to see a credit profile with positive activity. So shop around and get the best deal you can for your business. Now, once you choose a card and get approved for it, here are some basic guidelines to follow that'll help you manage your corporate credit card account so you can maximize its benefits. The first guideline is to get the credit card from your bank whenever possible, even if they don't have the best rates available. Once you establish a business relationship with a local financial institution through regular banking, continue to grow that relationship by applying for your business credit card at the same place. Because the more business you do at the bank, the more they get to know you. And the more they get to know you, the more their comfort level increases, and thus, the more likely they will consider your request for funding the next time you apply. Show loyalty to them, and that loyalty will be repaid in kind. They may even look to regularly increase your credit limit because of your loyalty. Second, read the fine print. Many credit card companies shout out low introductory rates, but their key word is introductory. See, what they won't tell you is that after the introductory period is over, the rate can shoot up above the interest you're paying on your personal card. Also, there might be hidden fees that can rack up if you don't track them and know exactly what should and should not be charged. But don't just read the fine print for negative information, because there are various other features that you want to make sure you get, ideally for no extra fee, such as overdraft protection, 24-hour customer service, and detailed expense reports. In the long run, these services are far more important business benefits than frequent flyer miles or discounts on rental cars. The third guideline is to find a card and stick with it. With all the offers of lower interest rates and appealing incentives, you might be tempted to switch your account from one issuer to another. But unless you are rather dissatisfied with your current company, stay put. Card hopping shows up on your business credit profile and will likely be unimpressive to a prospective lender. Use your time to manage your business instead of pitting one credit card company against the other. Fourth, don't mix business with pleasure. A business credit card is intended for business purchases only. In the event you get an IRS audit and they do occur randomly, questionable expenses will raise suspicion that you don't want. Fifth, you don't need a deck of cards. In fact, you shouldn't require more than 2 or 3 major credit cards for your business. The more credit cards you accumulate, the higher your debt potential, and it's easy to let credit card debt get out of hand. For example, say you charge $100 at the office supply store, then charge $300 of computer equipment to another account, and maybe $250 for gas, meals, and a nice little antique table for your conference room on a third account. That doesn't seem like much since each card still has a lot of available credit left on it. But if you do that consistently, when the monthly bills come, the totals can be a big surprise. And when they do come, if you can only afford to make the minimum payment, you'll never get ahead of the debt, and you may have financial problems if your market gets tight. So make sure to keep track of your weekly expenses as you make them, so you don't heap up a pile of debt that puts a stranglehold on your business. In fact, each time you take a card out of your wallet, ask yourself if the purchase is necessary and valid for the company. If it's not, don't buy. Or, if you are planning on buying anyway, make sure the business has the funds available to pay off the debt as a means of building its credit score. Guideline 6 is to understand that a credit card is not a loan. The card really shouldn't be viewed as a source of funding when cash is tight, simply because the interest rates and transaction fees are generally too high. Also, you should avoid taking advantage of the cash advance option whenever possible. Because if you think about it, if you're resorting to borrowing from your credit card, chances are you're not going to be able to pay the bill when it comes due, so just avoid it whenever possible. And finally, limit the number of users on the card. A company credit card is as much a demonstration of trust as it is a convenience for the user. Therefore, and this applies especially if you provide business credit cards to employees, you should review your monthly statements very carefully to verify that the cards are being used appropriately.
Business credit cards generally function slightly different than personal credit cards. There are some advantages to them and, of course, some disadvantages. Here's a brief list of some advantages and disadvantages to using business credit cards. Higher credit limits. Business credit cards generally carry higher credit limits to the tune of $50,000 or more, thus enabling more expensive business purchases. Such credit limits are typically not available to the average person on personal credit cards. A second advantage is that business credit cards can provide a boost in credit rating. Wise and monitored business card handling and timely bill payment can help to boost your business's credit rating. Also, having a business credit card saves you the trouble of sorting out business expenses from personal transactions. This makes the process of preparing your business's income taxes easier. Another potential advantage to a business credit card is the fringe benefits. These benefits are completely connected to the business and may include discounts on business travel, shopping at business supply outlets, and a host of other perks. And finally, a business credit card helps promote the growth of your business by facilitating timely purchases to meet immediate business needs. The first disadvantage to using business credit cards is their potential liability. See, a business credit card could carry the same personal liability as a personal card until a business has established its own credit history. So if the business defaults on credit card payments, a creditor can come after the person who signed the card for payment. Moreover, until your business has its own credit, your business credit card may be noted on your personal credit reports, and a few late payments could seriously damage your personal credit score. Similarly, A big debt increase for your business could make you look more financially overextended than you really are, regardless of your personal payment history. Another disadvantage is that you have less consumer protection with a business credit card. See, because business credit cards are meant to be used by companies, not individuals, they come with less fraud protection and less recourse than a personal credit card. Another credit option you can choose is called secured credit or a secured loan. With this credit, the lender will ask you to pledge personal assets or properties as collateral that'll serve as security for the loan. This kind of loan will let you borrow a much larger amount depending on your collateral and at a significantly reduced interest rate. Secured loans can either be long or short-term loans, depending on the lender and the amount you're borrowing. Unsecured loans are perfect for those who don't want to put their assets at risk by setting them up as collateral. Since the risk to the lender is higher compared to secured loans, they might be much more strict as to how you can use the money, and you will probably get a higher interest rate.
Now, all of these loans sound really great, but what about qualifying for them? What do you need to do? What do you need to provide? Let's answer those questions right now. The ability to get approval for corporate credit will depend on a number of different factors, including the personal financial credibility of the business owners or operators, the quality of management provided in the operation, as well as the short and long-term profit forecasts provided by the company. The lender may demand guarantees from the business owners that they'll be personally responsible for any corporate credit failings. In some cases, they'll also require that corporate debts be insured against any losses. Also, you must separate your business credit from your personal credit. As a means of doing this, you should set up either an S corporation, a C corporation, or a limited liability company. If your state requires registering with the city in addition to registering with the state, make sure and take that extra step. The reason you should use one of these corporate structures is because when you register the business, you essentially create a separate person that has its own tax identification number. That tax identification number effectively acts as the business's social security number, thus keeping your social security number totally separate from the business, which in turn keeps your personal assets totally separate. Your business should also open a banking account that's not linked to your personal account in any way. When you set up this account, you should be sure that the account has the correct business name, that the name is spelled correctly, and that the account includes a spot for your business tax ID. In addition to this, you should also have a business phone number that's somehow separate from your personal phone number. To go along with this, you might consider listing it in your local phone book as a business. You might also consider getting a separate mailing address for the business. You can rent a box that has a regular street address associated with it at a local copy center for a minimal amount. Once you have set up this foundation, the next step is to make sure your business is registered with a credit agency.
Before you can actually start building corporate credit scores and credit, you need to have a credit identity first. Recall that this is done by registering your business as a corporation or LLC. Different states have different requirements for incorporation and credit building, which can get complicated if you're not prepared. So you might consider discussing state specifics with an attorney or CPA. Also, please note that doing business as a sole proprietor will not allow you to distinguish your business credit from your personal credit. As a sole proprietor, you are doing business as whatever your company name is. However, you are not separate business entities. In order to establish business credit without a personal guarantee, you must structure your business as a separate legal entity, such as a corporation or LLC. Once you have established your corporate credit identity, by the way of registering your business, you need to obtain what's called a DUNS number, or DUNS. DUNS stands for Data Universal Numbering System, and it's a 9-digit number that creditors and government agencies use to gather information about your business. You can get a DUNS number through the Dun & Bradstreet website at www.dnb.com. After you have a DUNS number, the next step is to open a business checking account. Make sure to use the business's name on the account and consider applying for a business credit card at the same time. If you choose not to get a credit card through your bank, then as you set up the business account, you might consider talking to the finance manager about an SBA loan. After you have your business account set up, then you should start applying for vendor credit lines right away. Now, here's a bit of a catch-22. Many times, vendors want to see a little credit history before they'll give you credit. So it's best if you can get a few small loans, either by way of your business credit card or through the SBA, and pay them off just to show that history. When you apply for the vendor credit, make sure and find out if they report to DNB and/or other credit agencies such as Experian and Equifax. When you go to apply, you should also have your business's papers, such as the operating license, corporate tax ID or EIN numbers, DUNS number, business plan, and financial statements all ready. Also, take a little time to ensure all the legal papers of your organization are up to date, including your business license. Rarely will all of these be required, but if they are, it's nice to have them up to date and ready to go. One thing to note is that some lenders want to look at your personal credit as well. Doing so is common in the beginning until the business has a good payment record and paydex score. And by the way, it's okay for these vendors to look at your personal credit. Just make sure they don't file the credit as a personal line. Another element in building good business credit is to keep good financial records and have a solid accounting system that not only tracks accounts payable and accounts receivable, but is also capable of making forecasts and projections about financing and cash flow problems before they arise. One of the major reasons that many small businesses fail is that they don't properly track their financial situation. In fact, simply staying in business past the first 2 years will improve your business credit outlook. After that 2-year period, business lines of credit generally become significantly easier to obtain. In the end, the real secret to building an excellent corporate credit score is by following what's known as a 5-3-1 model. That is, start with 5 vendor lines of credit, 3 business credit cards, and 1 business bank loan, all of which report to the business credit agencies and none of which report against your personal credit.
So far, we have talked a lot about things you should do, but here are some common mistakes that, by avoiding, can greatly increase your chances of being approved for lines of credit, while at the same time building good corporate credit. The first suggestion may seem elementary, but check to make sure that you have completed all sections of a credit application. If a section doesn't apply, don't skip it. Instead, write NA in the response area. Also, make sure you include all required signatures and that you write legibly, because if what you write can't be read, it cannot be approved. This is especially important if you're planning on faxing or scanning application material. Second, include all requested documentation. If 3 months of information is required, don't assume 1 month will suffice. Have tax returns and other financial information readily available, and ensure your business name and account information match on your returns and the application. Excessive incomplete documentation can make owners appear unprofessional and a higher risk, thus jeopardizing the loan. Third, return all documentation, phone calls, and emails in a timely manner. Slow responses and missed deadlines may cause you to miss special promotions and increase your chances of being denied altogether. The fourth thing to avoid doing is buying credit. Absolutely do not indulge in this. Some companies sell business information to other organizations. If you choose to try buying in on what they offer, your business will be classed as high risk, thus making future credit lines that much harder to get. Putting personal assets at risk. If you personally guarantee any credit extended to your business, you seriously risk your personal assets, such as your car, savings account, and your home. The most common way entrepreneurs fall into this trap is by setting up their businesses as a sole proprietorship. If you have not set up your business as a C corporation, S corporation, or LLC, then you most likely do not have an EIN. Instead, your business is tied to your Social Security number. This also means you don't have the legal means to separate your corporate credit from your personal credit. Not paying bills on time 100% of the time. Everyone who has some type of credit file also has a credit history attached to it. And having just one late payment on a line of credit can be held against you for years. This is vital information for entrepreneurs who are working toward building good business credit. Even if you have separated your personal and business credit lines, one late personal payment could affect your corporate credit and your business's growth. The seventh thing you should avoid doing is trying to rush the process of building business credit. Just as it took time to build your personal credit, so too does it take time to build good business credit. The industry standard for building substantial business credit and securing cash loans without personal guarantees is 2 to 3 years. Don't rush your ultimate goal. By avoiding the above behaviors, you'll create a smoother, less stressful funding process for yourself while increasing your opportunity for credit approval.
An aged or shelf corporation is a corporation that is already formed but not in use and ready for purchase by a new owner. There are many reasons that people purchase shelf corporations, and there are certain things to look out for when considering one of these ready-made corporations. Shelf corporations enable new owners to engage in business, credit, or real estate agreements as an established company without having to go through the entire process of establishing a brand new corporation. Most potential creditors or business resources are hesitant to engage brand new or upstart corporations. So the theory behind a shelf company is that by approaching creditors as an established corporation or company, you will be more easily approved for credit lines. When evaluating a potential shelf business, you really need to evaluate and pre-existing bank relationships, agreements, Dun & Bradstreet credit rating, any past bill payment history, and as much information as you can about the former owners. Additionally, if you're going to seriously look into a shelf corporation, it's paramount that you only look at ones offered through reputed sources. So, when you find a company offering one, take the time to research them and see if they have done similar deals in the past. If you find a shelf business that you are interested in that comes from a reputable company, you still need to be careful, since some lenders will note a change of ownership on an aged corporation and subsequently view it as an entirely new entity, thus requiring some of the same criteria as new corporations. So know who you will request money from and understand how they evaluate a corporation for a loan. Then you can make an educated and effective decision. So now we reach the conclusion of this lesson. Hopefully you've learned a lot about some of the many ways you can build corporate credit. The main reason why this concept is important is to help you understand that you have other options you can utilize no matter what your personal credit or financial ability is. If you follow the guidelines set forth in this lesson, you should be able to build corporate credit that you can use to fund your real estate ventures. But having corporate credit is also a great way to ensure you're protecting yourself from personal liability. Because if you structure your business and lines of credit in the manner that has been discussed, the business will be the one listed on all legal documents, thus protecting you from any personal harm in the event the deal goes bad. Additionally, if you're not able to or interested in establishing your own corporate credit, you might consider establishing an LLC or corporation and bringing on a partner who has corporate credit already established through another entity. Similarly, you can look into purchasing a shelf company that already has a good history you can take advantage of. However you get it though, corporate credit is a very powerful tool that you should have access to and use as needed, but you have to take the time to establish it. Be persistent, as it won't occur overnight, and anyone who claims it does is just trying to sell you a jaded product.
In order to move your business forward, please complete the following action items before your next lesson. First, meet with a reliable accountant or attorney to help you determine which type of corporation or LLC best suits your needs. Then once you know what is best for you, go ahead and register the entity with your state and obtain an EIN number from the IRS. When you have everything registered, take a moment and set up a business checking account at your bank and file a new business account with the business credit agencies. Then go to dnb.com and register for a DUNS number. From there, you can go ahead and start building credit using the 531 principle. And as you follow that rule, continue paying your bills on time. Finally, keep track of your business credit score and work toward a PAYDEX score of at least 75.